Also, we gotta make sure people are muted when they join. People need to be muted when they join.
I'm muted everyone. I'm muted everyone.
Good evening, everybody. Oh, sorry. Welcome to our 2023 halftime report. I know it's a little bit hot in here, but I don't know how many of you were at our very first halftime report. And I forget how many years ago that was. I was trying to remember on the way over here. But I know Green, remember 10 years ago? What I remember, we used to have 2 annual meetings too, remember that? But we did our first halftime report was up at was it a Methodist church in Terralina? Yeah, it was super hot, no air conditioning, and they had these big windows that the sun, with no blinds or anything, that the sun was just blaring in. And then if I recall right, I think the audio visual went down too, so it's a lot cooler than that. Anyway, it's great to see everybody here tonight. I look across the room and I see clients that have been clients for a long time, 10 years, 15 years, 20 years. Do I get 30 years? I think I saw the Duncans here, and I think they think it's 40, but I'm reminding them that they're not that old. The other thing I see in this room is a lot of super smart people. So the super smart people are those people that are engaging with us in our weekly market commentary. So as you know, if you're receiving it, we have a riddle at the end, and I look at the riddle. Sometimes I can figure it out, and then sometimes it seems pretty hard, and I think that maybe I'll Google it. But then I thought that would be cheating, and I don't know how many of you are Googling this, but and I hope that I have everybody here tonight that are super smart people. Jean and Bruce and Lois and Kurt and Ava and Susan and Dennis, Gisela, Gwen, David, and Mike's on Zoom, and I know Carrie is a very smart person. So thank you for engaging with us. We really enjoy it. By the way, my name is Tim Russell, in case for those that don't know me, and I am the founder of Valley Oak Wealth Management. And it's a lot easier doing these events when the accounts are up, let me tell you. The reviews are getting easier, and this meeting is going to be a lot easier compared to January. And since January, there's a lot that's gone on. And on April 29th, we did our annual big shred event. And that shredding event, every time it comes around, because it seems to come around quicker and quicker, and I go like, God dang, this thing's a lot of work. And we go, yeah, should we do it again, you know? And quite frankly, I'm not doing the work, Anne's doing most of it, and everybody else. But when the time for the event, when it comes, it's just so exciting, and we really enjoy doing it. And we like to kind of showcase how organized we are, and we try to be super organized and impress not only you with our organization, but the public. And it is the one event that we actually advertise. So we raised a little over $11,000 for the veterans housing with Home Battle. So that was just to go to the program for the veteran housing complex that they're building. We filled up 2 large shredding trucks before 11:30, and let me tell you, they were bulging. I'm telling you, it was quite a sight. And we had a lot of support from volunteers and other colleagues. It was Hennessy Funds helped with matching donation, Call and Medcap Accounting Services, Valley Oak Tax Advantage, Our Lady of Loretto Church and School, of course. Rushworth Consulting and Unicorn Group did the printing for us for free, so we couldn't have done it without them. Just some LPL news. You'll be receiving your annual disclosures here in the next month or so. I know that if you have more than one account, you're gonna get more than one disclosure. I know it's a little bit messed up, but I can't control it, but I'm just giving you the heads up. So if you have a couple accounts, you'll get a couple of disclosures. It's just all the, the annual legal requirement stuff, so nothing to worry about. The LPL is gonna come out with some new statements. I think that they're pretty cool and innovative, and Tom's gonna talk a little bit more about that. Account view, so where you guys are going online to look at your accounts, there's a new account view. I don't know how many of you are on the new one versus the old one, but everybody's gonna be migrated over to the new account view, whether you like it or not. They're gonna be shutting down the old account view. This will happen over the next 3 months. I know, human beings, we don't like change, but I have seen the new account view and it's much more modern and it's easier to use. You can use it on your phone. You can do deposits. You can change your beneficiaries. So I think you'll find it, once you get used to it, very helpful. The last thing I wanted to talk about as far as LPL goes is that you're able to text the office. Most people don't realize that, but you can text the main line and we'll get the text message. So if that's more convenient for you, just go ahead and do that. We won't be able to honor any investment instructions, so you'll still have to call the office, but if you wanted just to send a message, you can do that. I'm sad to report that after 8 years of working with Vince Chisholm, he's going to be retiring. This is his last season of doing taxes. And I honestly didn't recognize him in a suit because he's usually wearing shorts and flip flops. So Vince, it's been great working with you. I can't believe it. It's been 8 years. He comes in the office, he's always smiling, he always says hello, and it's been a real pleasure. But out with the old and in with the new. Vince helped us find a suitable replacement, Donna Delina. Donna, where are you sitting with Vince? Where she is back there. And Donna have worked together at H&R Block. And so Donna has 9 years at H&R Block. She was a senior tax specialist. She grew up in Marin County in West Marin. She grew up in Alima, Point Reyes Station, and she currently lives in Petaluma. You'll find her very delightful, very knowledgeable, and your experience working with her is going to be exactly the same as Vince. It's seamless. Everything's still going to be the same. You might have noticed a new face here today, a new team member, Lisa Ratto. Lisa is a breath of fresh air. She was born in Novato in the old hospital, and she still lives in Novato. She has most of her experiences in the mortgage business, but where she learned customer service. So if you have interfaced with her at all here or on the phone, you'll know what I mean. She just can't wait to answer the phone and help you, and so excited to do that. So Lisa, it's great to have you part of the team. Thank you. I was gonna say that her last name's Ratto, and she's part of the Terralinda Ratto family. So probably some of you might know that. She told me to tell you that she's married to T.L. Ratto number 9. So how many Rattos are there? 11. Yeah. As you know, we like to have an intern every summer. So I'd like to introduce our intern, Matt Smallback. So Matt is planning on being a wealth advisor, so you might see him come back after he graduates from Vanderbilt University, where he studied business and economics. He grew up in Corte Madera, and he went to Redwood High School, and he played baseball and football there. So unfortunately, Matt's last day is the Wednesday, right? Yeah. So I know Will's gonna miss you, and you finally have somebody his age in the office. Speaking of Will, so Will just celebrated his 5th anniversary, and he actually started at Valley Oak Wealth Management as an intern. Will, as you know, is licensed. He does the research. When you call and you need money, he's the one that frees up the account. If you sell something, if there's money, if we need to do that to raise the cash. Like I said, he does the research. He kind of does everything in the office. Hopefully, the plan is that he's going to get a CFP in just a little over a year, right? A year from next month. So that's what he tells me. So, and then Tom Davis, you all know Tom. It's funny because I was thinking, why do I always start these meetings? And I figured it was always like worst first, right? So Tom, I think we said that we're in the 8th year, right? Is that what we decided? Okay, so Tom and I have been working together for 8 years. He's the other advisor in the office. He's been affiliated with LPL for 17 years. And then, of course, you know, Anne, wherever she is, and is in charge of meeting. Anne does all the client communications, and she's kind of the liaison between the city and us and the community. So I'm sure this has all happened to everybody, where you walk into a room and you don't remember what you went in there for, or you get introduced to somebody and then you can't remember their name, and or you're searching for those words. I'm reminded about this story where there was these 2 couples that were in the park, and they were walking down this path, and the two women are ahead of the 2 men. I know, Kareem, you've heard this joke before. And so the one guy goes to the other guy, goes, you know, last night we went out to dinner and I had the best steak. It was cooked perfectly, super juicy. I just couldn't believe it was reasonably priced. And the other guy goes, wow, I love steak. What's the name of the restaurant? He goes, what's the name of that flower? They come in different colors, they smell really good, and they have thorns. Guy goes, Rose? Yeah, that's it. Hey, Rose, where did we have dinner last night? So we got together in January, and as you know, and just kind of looking back at the market since then, we started the year pretty concerned. Consumer sentiment was very, very low, and there was a reason for that. The stock market was down 20%. We had high inflation. Interest rates were way up, and most people believed that we were going to go into a recession. But what's happened is that the economic slowdown hasn't come. There's some contraction in part of the economy in manufacturing and retail, but unemployment remains really strong. And for most part, most investors' personal economies are doing pretty well. So the economics forecast remained strong. Earnings were better than expected. Inflation declined, and the slowdown didn't happen. So we saw the stock market go up for the first part of the year, pushed higher through April. Then the AI craze hit, and the super cap tech names carried the S&P 500 higher almost all by themselves. And it appeared at that time that the broader stock market was rallying hard when it was really only 5 stocks. And the worries about a recession and corporate profits declines were basically gone. This caused the people to chase the market even higher. And then the June economic indicators came out, and they were very positive. So we saw a broad market rally in June, and it wasn't just tech this time. Now we're looking at a market with yearly highs that's threatening to actually reach, the highest we've seen, but it's basically on 3 assumptions. Number 1, falling interest rates. 2, we will need to see further economic acceleration and an increase in earnings and share for the S&P 500. This is what it's going to take for the market to push through 4,600. And while the fear of the market decline, the economy going through a recession hasn't actually diminished, that risk is still present. And probably the easiest way to talk about the risk is just to say it's exactly the same risk that we started the year with. The risks are, of course, there's still a risk of a recession, which we do believe that we will go in. We still have stubbornly high inflation. We still have the concerns for the Fed's hiking too high and earning declines. And the fact that none of these risks have materialized doesn't mean that they don't exist. So one of the things that, we pay attention to are our indicators. We try not, we don't, I don't say try, we don't get emotion involved. We still are taking a pretty conservative stance. So in most of our portfolios, we're only about 50% in stocks still. We are in the midst of discussing reducing our technology position and adding more in dividend paying stocks. But that wouldn't change the component or the mixture of how much we have in equities. So that's probably a trade that you'll see next week. We're just in the kind of discussing it now. Before I close, I just kind of wanted to reflect on something that Will and I and Tom and Matt were talking about. And that is why are the Feds why do they keep raising interest rates when clearly inflation is declining? And what if it's not inflation that the Feds are looking at? What if it's something else? Well, a couple weeks ago, I ran across a report that Ben Bernanke put out. Remember Ben Bernanke?
Yeah.
So he put out this 50-page report back on May 23rd. And basically in the report, what he said was that the inflation spikes that we saw in 21 and 22 were supply chain issues and had very little to do with rising wages. And the reason why this is important because supply-driven inflation will reverse over time. So what happened was we had retailers, they saw their inventories plummeted during the pandemic, the supply chains froze, and then prices spiked. In response, the stores over-ordered, and then supply chains normalized, and then the stores had to discount heavily. And this is why companies like Target struggled, and companies like Bed Bath & Beyond went out of business. And the reason why this is important is because supply-driven inflation will reverse itself over time without any Fed intervention. But the Feds have raised rates aggressively. And why is that? Well, according to Bernanke's paper, he's saying it's because of a tight labor market. So the source of constant upside inflation, a tight labor market is a source of constant upside inflation. So getting the labor market in balance should be the Fed's highest priority. And unfortunately, there's been very little progress there. So we think we're going to see at minimum another 50 point rate decrease, at least 0.50, 2 more quarters, possibly more. So the labor market can turn quickly, so this isn't necessarily a negative. But I think what it tells us is that we need to shift what we're thinking and not look at what the Feds are not looking at inflation as an indicator, but looking at the unemployment rate. And the key is that we want to see moderation. So we like to see unemployment go up, but not drastically, just in moderation, so the Feds won't overreact. One thing we know for certain is that there is no certainty. And I talked about our investment process just a few minutes ago, and I wanted to say that there's no I think, there's no I feel, there's none of those emotional words in our investment process. And when we make a decision, as I said, that we're going to probably reduce our tech position, we're going to do that for everybody across the board, including our own accounts. Because as you know, we invest our money right alongside yours. I want just to close by saying thank you to everybody, and that on behalf of the whole entire team, I wanted to thank you for being clients, for such loyal clients and great clients, but more importantly, for being friends. And we all appreciate you very much. We know we wouldn't be here if it wasn't for you. And we love coming to work every single day. We love it when the phone rings because it's an opportunity to help you. So thank you again, and I'll turn the meeting over to Tom, who's going to talk a little bit more about the strategies. Thank you.
Thanks, Tim. How's everyone doing this evening?
Right.
All right, good. I'll make this kind of quick, but I'd like to share some areas of the market that we favor right now and discuss some of the trades that we've done and strategies since the last time we got together in January at the forecast meeting. So in regards to equity, we made some small tactical moves. In February, we added a 5% position in Developed International and slightly reduced our cash position as well as our large cap value position. In our sectors, as Tim had alluded to, the sectors we like are healthcare, technology, and industrials. And the early part of the year, we added utilities in the portfolio. And it's also worth noting that we do own some AI positions in our technology sector positions. So that's a good thing. In our fixed income and our bonds, we've increased our exposure into core bonds. And by doing that, we decreased, in order to do that, we decreased our position in short duration holdings. And we've retained our long-term duration bonds in anticipation, as Tim again alluded to, that we think that the Fed is closer to the end of the rate hike cycle than the beginning. So, there's always going to be areas of the market that outperform depending on the current market conditions. So, it's our goal to make sure that we're flexible in this ever-changing environment. So there's that, and then a little housekeeping issue. We did. LPO is actually in the process of making some positive changes with regards to your account statements. So it'll be a little easier to read. And as of June 2023, last month, what they did is they moved from monthly distribution or monthly statements to quarterly statements. So a little less paper to shred at the shredding event. Secondly, what they're going to do is they've made them a little bit more modern and easier to read, which I think you'll all enjoy. They're going to have a clearer representation of the value year to date as well as quarterly, so it'll be a little easier to check on their performance. They're also, for you tech people out there, you're going to have a QR code on these statements, and what that's going to do is allow you to access the summary page for extended interactive statement information. So that's a mouthful. So look for these new changes. I think you're going to really like them. And the last, kind of in closing, I'm going to turn it over to Sean Bittinger from First Trust to introduce our speaker, Chris Bush. But before I do, I want to mention that we are an independent firm. We get to choose who we partner with in terms of money management. We have this little circle of trust, and First Trust happens to be in the circle of trust. That's a mouthful. Lots of trust in that. And then, First Trust is not affiliated with Valley Oak or LPL Financial. So thanks, guys. I'll hand it over.
All right. Thank you, Tom. Thank you, Tim. Appreciate allowing First Trust to be here. Appreciate you all coming and listening to the message that we have for you as well. So First Trust, just a quick introduction. We are a private firm. We pride ourselves in that we are based out of Wheaton, Illinois, so a small community suburb of Chicago. We enjoy partnering with financial advisors. Our business is really to work with financial professionals. And so we love working with teams like Valley Oak that are involved in the community, doing community service, owning a historical building. So giving back, right? Being the backbone of a small city in a community like this. So we pride ourselves in that, being able to offer resources to teams like Valley Oak. And really what First Trust, how we kind of differentiate in the space is we really focus only on the data. So what we talk about is sort of shredding the narrative that you get from media, that you get from politicians. And we help advisors focus on the fundamentals and focus on the data. So we are happy to have a member of our equity research team here with you to provide a little bit of an update on the fundamentals of the market, what we're seeing, where we've been, kind of where we're going, and give you guys some takeaways, and kind of understand where we are today. So we've got Chris Bush in from Chicago, and look forward to sharing our message with you guys. So thank you.
Thank you, Sean, and thank you, Valio, for having me out tonight, and for everybody coming out on a Thursday night to get a market and economic update. So what I want to do today is spend a little bit of time on the economy in the stock market, and hopefully I could demystify it a little for you. Because right, everybody last year thought the market was going to go up, and what did it do? It went down. This year, everybody thought the market was going to go down, and it went up. Okay, so what's going on? And so really there's three indicators or three key market drivers that I always look at and say, where are we at the stock? So the first thing I always look at is where are interest rates at? So if interest rates are higher, okay, what does that mean? That means that you can earn a return without taking a lot of risk, right? If you're investing in cash. Like today, this really cool thing you can do is you can go and buy a short-term treasury, make close to 5%. So that's the first key thing we look at, and we'll go through all this. The second key thing I look at, and really the key over the long run for if the stock market goes up or not, like Sean was talking about, is the fundamentals. So the fundamentals is corporate profit. So we'll get into that. So what kind of businesses do you want to buy? You want to buy businesses that make money and that continue to make more money, right? Because that at the end of the day, if you're going to go out and buy a business, what kind of business do you want to buy? You want one that makes money and continues to grow. And then the third key driver of the stock market is sentiment. How you're feeling about the market. And this is where it gets a little bit tricky because in the near term, it really, a lot of what happens in the market is based on how people are feeling about the stock market. And what you've seen this year is you've actually seen a couple of big different sea changes. You've seen the banking turmoil in March where people got a little bit nervous. But then what you've seen over the last few months is a little bit more of a euphoria around what's going on with AI. And we can talk about all that. But from a high level, those are the three key indicators we look at. And what we would say today is, look, the stock market over time returns about 8% per year. It's really good to be invested in stocks over the long run. However, the market today, there are more headwinds than we've seen in quite a while. So that's where we do see still positive equity returns if we look out in the future, but they're probably going to be lower than what you've experienced last decade. Last decade has been 10 to 15% returns on the S&P 500, a broad-based index of the largest stocks in the US. And you're probably going to have more volatility ahead because there are more headwinds than we've seen in a long time in the US equity market. But with that, I think it's important, and sorry, this chart is a little bit small. It's important to know that when you turn on CNBC or any other major news station on the stock market, that we're all taking guesses on what we think, educated guesses. And what's really interesting is the smartest people don't always get it right. So this list up here, and I know it's really hard to see, but these are all the smartest guys on Wall Street and their predictions for what the S&P was going to do last year. Okay, the smartest guys on Wall Street predicted that the S&P was going to finish at 5,000 last year. It actually finished under 4,000. Okay, so we get it wrong all the time, and in the near term, it's really hard to predict what's going to happen in the stock market. Flip ahead to this year. What did everybody think? The smartest guys on Wall Street think was going to happen this year? They thought that the market was going to be at 4,000 on average. So the smartest guys in the room said 4,000. Today we're right around 4,500 on the S&P 500. So they were wrong again. Okay, but at the end of the day, it's really hard if you look at the market from a 1 week or 1 month or even a 1 year perspective on what it's going to do. But that's where I go back to the three things that we talked about: the interest rates and earnings and sentiment. Because if you can know where those are, over a longer time period, you can have a better idea of where the stock market is going. And the first one I talked about was interest rates. So this is good news, bad news. Like I was saying, the good news is now, if you're buying bonds or cash, you can actually get a decent return for the first time in a long, long time where we didn't have a zero interest rate policy. But the bad news is a little bit of a headwind for stocks for a couple reasons. Number one, are you willing to pay as much for a stock if now you can go over here and get 5% without taking very much risk? Probably not. And what we saw last year was we were supposed to get, according to the Fed, 325 basis point rate hikes. Because they all said that inflation was transitory, right? And clearly there was parts of it that were more transitory. The good side of the economy, obviously, you couldn't get a dishwasher for a year. There was other parts of it that you couldn't get, but at the end of the day, a lot of that inflation wasn't transitory because we printed a lot of money, we gave out a lot of money to consumers. So that's number one. Number two, I haven't talked about the economy as much, but pretty much every time you raise interest rates, what does it do? It helps to start to slow the economy. That's a natural progression. We know it's very simple. You go out today and you try to get an auto loan, you're not getting zero interest rate financing anymore. It's a lot more. You want to go buy a new home, you're gonna have to pay 6 or 7% on a mortgage. So when the Fed raises interest rates, it constricts the money that's out there, the available credit. So that is a headwind. So we look today, why we're saying that we're probably not gonna have as high returns as we've had in the market over the last 10, 15 years. Part of it is interest rates are a headwind today in the US. And what we would say too is, look, it's great that CPI is coming down, that it's in the 3-4% range. But you also have to remember, we're coming off historically high inflation last year where it was 9%. So that's a cumulative, we're still paying more and more for all the goods that we're buying or the services. Man, it's amazing, like Chicago, I'm from Chicago, it's pretty expensive in Chicago, but I bought a couple smoothies this morning and I spent like $60 with my wife and daughter. So I'm like, this is really bad. Like I can't even show my wife the bill because she wants to go back there tomorrow. And I'm like, I don't know. So we all know things are costing a lot more. Inflation is clearly not fixed. And here's the thing, is the Fed gonna maybe raise one more time after they skipped last meeting? Next week, they're gonna have a meeting and they're probably gonna raise next week and maybe they're done. But interest rates aren't going back down to zero interest rates policy where we earn zero. So this is gonna be a little bit more of a headwind where most of the last 10, 15 years, I'll use one Wall Street term that we use, it is called TINA. There is no alternative. There was no alternative really to stocks over the last 10, 15 years where you could get a decent return. So interest rates are a headwind for those reasons. And I'm sorry, this chart is really small, but this is a chart of different asset class returns over the last nearly 100 years when we had above average inflation in the US. And like I said earlier, the average return on the stock market is about 8% a year. If you look at this chart, the S&P 500 is in the middle. And so when this is any period when inflation was above 2.7%, and what you'll see, the average S&P return was a little bit over 4% in any period when we had above average inflation. So it makes sense, right? Because we have higher interest rates when we have higher inflation because we got to bring the inflation down. So that's why you have slightly lower returns, but still positive returns on stocks. But where I want to spend more of my time, and where I spend a lot of time on my job, is looking at corporate profits in the US. So what's pretty amazing is this is the earnings on the S&P 500 for 500 largest stocks in the US by year. What you'll see that's really amazing is if you look at 2019, that was the previous peak in profits in the US. So the S&P earned about $165 per share. You fast forward to last year, we earned $220 per share on the S&P 500. So you think about what drives companies to go be worth more over time. It's, are they making more profits? And you look from pre-COVID to today, profits went up about 35 to 40%. Stock market's up about that much as well. So at the end of the day, It's just like if you were going to buy a private company, you want a company that makes money. And US stocks especially have been doing very, very, very well. All right, so that's the good news. The bad news is that first orange bar there is a little bit lower this year. What's happened in the US? We've actually had corporate profit margins get squeezed a little bit. And what you're seeing actually is corporate profits are expected to be about $215 this year, or about 2 to 3% lower than they were last year. So that's not the end of the world, right? That's a little bit lower, but at the end of the day, if corporate profits are doing this, that's not a good thing because companies should be worth a little bit less in that scenario. So that's the corporate profit picture as we look forward. And by the way, the stock market is always a forward discounting mechanism. Okay, and what I mean by that is what the stock market does is based on expectations. So the expectation coming into this year was that profits were gonna fall by a lot more. And that just hasn't materialized, right? This has been the recession everybody's been predicting for a number of years now. It's always 6 months out and it keeps getting pushed out. So part of why the market is up as much as it is because a lot of people thought we were gonna get a recession to start this year. And that just hasn't happened, and earnings have held up a lot better. Now, what I would say from here, and why I'd be a little bit cautious, is now everybody's expecting us not to have a recession. Not everybody, but the majority of people think we're gonna get a soft landing or a no landing. And the problem with that is if that scenario is the base case now, what most people expect, then if we actually do get a recession, there is downside to this equity market. But I do want to go a little bit deeper on the earnings picture, because I think this is pretty interesting, and sorry, these slides are all really small. But what I did here is I went back the last 100 years, so we're still talking about earnings, and earnings are a key input. So I thought it would be interesting if we look back as far as we go back historically and look at when we had high inflationary periods, how did corporate profits do? What's interesting is you'll see here, the S&P 500 on average grows profits by about 8% per year. Now that's pretty interesting, right? Because what did I say the S&P goes up on average per year? About 8%. So see, at the end of the day, it's gonna be those fundamentals, it's gonna be those corporate profits that are gonna lead to higher stock market prices. Now you look today, or you look at periods when we had above average inflation, corporate profits actually grew slightly faster. So at the end of the day, stocks are a pretty good inflation hedge, because what do we all know? We know that when prices go up on companies, what do? They charge you more, right? They're gonna raise their prices. So I do think corporate profits are a little bit of a mixed bag today, that we're making a little bit less, and that is a headwind along with higher interest rates as we look at the market today. Okay, the third major driver of the stock market, and this is the hardest one to gauge, because this is where the animal spirits of the market come in, and this is when you're scratching your head, and that is sentiment. So how people are feeling about the stock market. And in fact, there's a survey every week put out by the AAII, and it's called the Bulls Bear Survey. And what they do is they actually call individual investors like yourself and ask, how do you feel about the stock market? And then you respond to the survey. What's really interesting about the survey is that it is a very good contrarian indicator. So if investors aren't feeling so good about the stock market actually tends to do really well over the next 12 months. Actually, the returns over time are close to 15 to 20%. However, if investors are feeling really bullish on the economy, the stock market actually only goes up about 4% over the next 12 months. So more than 50% of individual investors are bullish. Stock market goes up about 4% over the next 12 months. What's really interesting about this year is, guess what? Coming into the year, individual investors were very bearish. The average individual investor, there was only like 20%, 20 to 30% for most of the first part of the year. They're actually bullish on the market. And what have we seen? We've seen the S&P that has gone up a lot. You look today, actually, just over 50% of individual investors are now bullish on the market. So it's the first time in a long time or more people are bullish than are bearish. And so that kind of can be, you know, a little bit of an interesting scenario that we have playing out. Because what's happened, hey, people are feeling pretty good because the stock market's been going up this year. We've all tried Chat. Has everybody tried ChatGPT in this room, or at least heard of it? Probably some of you. I actually tried it for this trip, tried to plan a little, you know, what to do, but it's really cool technology that we can touch and feel, and we'll get a little bit more into that. But people are pretty excited about this, and it's really driven positive sentiment on this market. But when you put this all together and you look at the stock market, remember my 3 key drivers, interest rates are a little bit of a headwind today. They're higher than they've been in the last 10 to 15 years. Corporate profits are falling. And then you have really positive sentiment that has driven a lot of this market gain this year. When you see what you're paying for stocks, and what do I mean by that? There's a basic metric in the stock market called the price to earnings ratio. It's really simple. It's how much earnings is a company making relative to the price that you're willing to pay. And think of it this way. If I was going to buy a small business, what's the first questions I'd ask? I'd ask how much does this business make, right? Well, I want to know how much the company makes, and then I also know how much do you want for this business? What do you want to pay for it? So think of that as the PE ratio. And today, you look at the stock market, it's actually trading at an above average PE ratio. So it's a little bit expensive compared to history. Now, it's not as expensive as it was like the dot-com bubble, but it is above where it's historically been. And when you look at that, and the fact that interest rates are a headwind, corporate profits have fallen, and that investors are really euphoric about this market right now, that does lead me to think that it is a little bit of a mixed picture today, and you have to be a little bit careful where you're investing today, because there is some risk to this market. And that's why I'm saying also, it's like, you still need to be invested in stocks. Now, this is why you obviously hire a great firm like Valley Oak, where they can manage your risk reward. And like they were saying, they're allocating more to bonds, because they do see some overvaluation in some parts of the market. Because in times like this, where it's actually a good thing, right? Where investors are feeling a lot better than you guys probably were if you were at the last meeting, because the stock market wasn't up nearly as much. So that's a high level view of the stock market. Hopefully that's helpful. I do want to dive a little bit into the stock market, because this might be a little surprising to a number of you in this room. What's really interesting right now about the stock market, it's more concentrated than it's been in a long time, even more so than what we saw in the dot-com bubble in the late 90s. In fact, you'd have to go all the way back to the Nifty 50 in the mid 70s to see it as concentrated a market. And today, if you just buy the broad-based benchmark, about 25 cents of every dollar goes into just 5 names. So you're not even getting that much of a diversified portfolio today if you're just buying the broad benchmark. And even more amazing, you look at the NASDAQ 100, which is a very tech-heavy index, 60% of the weight is coming from the top 10 names. And this benchmark is actually so concentrated right now that tomorrow after the close, the NASDAQ 100 is actually having a special rebalance, because there's certain rules to, in a fund, you have to have a certain diversification standard. So this has only happened twice in its history. So we are in a very unique time right now where you think about, you hear these benchmarks you hear on TV if you turn on CNBC, and they're actually becoming very concentrated, more so than they've been in 40 years. And here's the good news, though. I'll tell you about the stock market. There's still opportunities in the stock market. There's still really good values. And I was saying, hey, look, if you're buying the S&P 500 today, 25% of your weight is in 5 names. The top 10 names is about 32% of the weight. Here's the bad news. Those top names in the market, they're all really good companies. So that's the good news. And you know them, they're like Microsoft and Apple and Google, and obviously a lot of them have started around here and they've done exceptionally well. But the bad news about them is the valuations are really expensive. So if we go back and look at that PE ratio, it's much higher than the average stock on the S&P 500. So the good news is if you look at smaller companies, the valuations are actually a lot more reasonable. And here's just a little food for thought, and I know this is hard to see up here, but there's a very powerful force in the markets. It's called reversion to the mean. So what we've seen is a lot of these big tech names do really well, and they're all great companies. I would not argue with you at all on that, but it's really hard to stay as one of the largest companies. And to show you this, if you look at the last 6 or 7 decades, you can see what were the largest companies in the US. And I will show you, if you go back to 2000, you can look at this list. Hey, Microsoft's still there, obviously a really good company, but then you look at some of these other companies on the list. Okay, Lucent Technologies. Anybody remember Lucent Technologies? Yeah, that was a Chicago-based tech firm. That never works out well for Chicago. You don't want a tech firm in Chicago. You want a tech firm around here, right? They're gone. You have AOL Time Warner, probably the worst merger of all time, when Time Warner decided to buy AOL. We didn't do dial-up for much longer, right? Broadband came out. And you can see some of these other names on the list, General Electric, they've actually returned about 0 over the last 25 plus years. Now, here's what I'm saying though, I'm not saying 2000 was different than today. You look at the top of the market today, these are really good companies. A lot of them have really good businesses that aren't probably as likely to get disrupted as some of those businesses in 2000. But you just don't know, right? Like you could take the example of what is ChatGPT, where I can just ask it anything and give me an answer. Could that disrupt some of Google search? Potentially, right? Google's 93% of the search market today. Even if their solution is really good, maybe they get disrupted a little bit. So it is really hard to know over the long run who gets disrupted and who doesn't. And coming back to this is so this is a little bit of an industry term, but you look at the attribution of the market here today. So where does your returns come from? That's just what attribution means. Like Valio was saying earlier, almost all the return has come from 7 stocks. And now this is where it gets really interesting, because if you look at some of these companies, they're actually expected to make less money than they did last year. And some of them, their earnings expectations, so what people thought that they were going to make, has come down. But their stock prices are up a lot. So you do have to be a little bit careful in a market where people are just willing to pay more and more for stock when your profits aren't coming up. And you understand that if you were buying a private business and it made the same as last year, why would you pay 40 or 50% more for that stock? And this is continuing on the same thing, a theme about it is such an interesting market. It's such a concentrated market. So you look today, only about 28% of stocks are beating the S&P 500 because at the top of the market, these biggest names have won over time. And you look at history, this is actually a narrower market than what we saw in the dot-com bubble. So even more concentrated. And like I said, you have to go back to the Nifty 50 in the mid-70s to see as concentrated market. Now here's what I would say though. We all know Microsoft and Google and Apple are really good businesses. Do I think that they're going to fall off a cliff? No, I don't think their prices are going to crater. But what I do think is going to happen is if you look at periods like we've seen here, where it's been a really concentrated narrow market, what tends to happen is it tends to widen out, and a lot of these other names tend to play catch up. Like I was showing you, the valuation gap that you're paying is huge year to date. All right, should we talk about banks for a minute? I know we're kind of in the epicenter of Silicon Valley Bank and where that happened. Let's say, I think this is some good news here. If you look at banks, what I have on this chart here is, I think the one point to really hit home is what has happened is completely different than what happened in the financial crisis. So the financial crisis, what happens, we had a ton of bad assets, toxic assets on our balance sheets. Okay, and so if you look at this chart here, if you just look at the orange bars here, that is what banks set aside for loan losses. Okay, so what you'll see is you saw a spike right during COVID, the banks set aside a ton of losses, but then what happened? The losses never materialized, right? Our economy actually did really well. Now, I think we're gonna pay for it coming forward, but we did induce a little bit of a sugar high by giving all these stimulus checks out, not making anybody pay on their student loans, so the consumer was really strong, and then we printed a lot of money during COVID. Now, all of that is reversing, but if you look today, the rate at what loans are going bad on banks' balance sheets is still extremely low. Now, I know we're really close to San Francisco, and we have commercial real estate there that's not doing so well, but there's obviously some other reasons for that. But by and large, banks from a financial perspective, are still doing reasonable well, that their assets aren't going bad. Now, what we had happen was, there's a few banks that went out and said, I have all these extra deposits. So how a bank works is you get deposits, hopefully you pay as little as you can on deposits. So if you look the last 10 years, if you had a savings account or a checking account at your bank, you were probably getting as close to zero on that interest rate as possible. And then what banks try to do is they try to go lend that money at a higher rate, and what they do, so maybe they made a 5% loan to this company, local company, and they made what is called a net interest margin, so they made a spread. Now, what happened with a lot of banks, and Silicon Valley Bank in particular, is there wasn't enough loans to make. So what did they decide to do? They decided to buy longer term treasuries and mortgage-backed securities. Because what they could do is make a spread, and you kind of feel for them, because what did the Fed tell us last year? That inflation was transitory. So what they ended up doing is they bought these bonds that had like a 10-year or longer duration, what we call this is really long term. And what happened to all these bonds is when the Fed did 17 25 basis point rate hikes last year instead of 3, is these bonds became worth less, right? Because they were getting paid 2.5% on this debt. And over here, you get 5% at the front of the curve. So unfortunately, there's a few banks that at the end of the day, took too much risk over here. And then when depositors asked for their money back, they couldn't give it all back to them, and they got taken over and put into receivership. Now, what I would say is right now where we're at is it's more of a bank walk than a run. And obviously, if you were in a very tight market, it would, but that's on banks. So our bottom line is completely different. And I'll end with this slide. It doesn't look quite right on the slideshow, but what this slide shows, it should show, I'm not sure what happened here, is that 3 out of 4 years, the equity market tends to go up. So if you look at the last 100 years, 3 out of 4 years, the equity market does tend to go up. If you look at last year, the market was down 18%, the S&P 500. The tech heavy NASDAQ was down 35%. You look at that, that was a little bit of an anomaly. That was the 7th worst year in the last 100, but over time, it does pay to stay invested and be long the equity market. However, we look today because of valuations, because of interest rates and some of the headwinds to earnings, it is probably going to be a little bit more of a bumpy ride. And that's why you guys do hire a great company like Valley Oak to help mitigate that risk and put you in the right opportunities for investment. But with that, I'll wrap it there, and then are we going to do some Q&A?
Yeah.
Yes.
You guys see that the market seems like it's going up a little bit, but I'm anticipating that at some point, I realize that the interest rates are gonna go up, but you guys see at some point they're gonna start coming to the Fed and start making it on the downward side.
Yeah, no, that's a good question. So the Fed, it always works with a lag, right? It takes a while for those interest rate hikes to affect economics. It's not like you have to go out tomorrow and buy a car, but you might have to buy one in a year, and now my interest rate's higher. So you look at what the market expects, they expect them to raise rates next week and then it to be done. And then sometime, probably early next year for the market, the Fed will start cutting rates.
Quarter point next week.
Quarter point next week, and then, but we would say inflation's not solved yet, so the Fed could be in a really sticky spot where inflation, they have a dual mandate of inflation and jobs. Now, they have still have some room, right, because unemployment is incredibly low. But it could be possible that we have cuts next year, but what I would say is, we're not going back to where we were, where interest rates were near zero, like there's just too much inflation still. If the Fed wanted to today, like if they wanted to get to their 2% target, the inflation, they could do it, right? All they'd have to do is raise rates by 400 basis points, or 4%, you destroy the economy. So, what are they gonna do? It's hard to say, but it's probably one more hike and then they're done, and then next year, it's very up in the air, with where rates will go. Yes.
You haven't been to the dollar. And the effect the dollar seems to be fairly gradual development. But the Bitcoin is coming in, and I'd be very interested in your comment about it.
Yeah. So,
Dollar and Bitcoin.
yeah, so on the Fed coin, right, the Fed coin specifically, yeah, so they're looking at doing a coin from the Fed, obviously, as an alternative to Bitcoin. It's a little bit interesting to me because, and so the advantages would be, it'd be instant transactions and it would be, totally secure, right? Or at least if you trust the government, it should be a secure, quick transaction. What I would say is, look, right now, if you look at the financial systems, you can move money really easily. And I think the big question is, will it be adopted? Because a lot of people like Bitcoin because it's decentralized, right? So I don't think you're gonna get those people, a lot of those people don't necessarily trust the government that they're using Bitcoin for transactions, so it's to be determined. I think there will be one because it just makes sense with where technology is going. But I think the big question is, will it be widely adopted or not? Because you look at, do you want to trust are you gonna keep using the systems that we have that the big banks use that are really efficient today? But good question, yeah.
The rumors are the press is talking about replacement of cash, not of Bitcoin.
Yeah, so obviously, you look at the money supply today, most of it is not physical currency, it's in digital. And obviously you could remove more cash from the system for sure, and make more of it digital.
What does that do to the market?
Was it due to the market? Honestly, I don't, unless it's like a government takeover situation, I don't see that's what the government wants to do, who knows? Like, but obviously, if it's the digital currency gets very political, but it probably, I mean, at the end of the day, Bitcoin hasn't had a major impact on the stock market. It's just another form of currency that you can go buy and sell. So it will look like I'd say the Bitcoin's had the biggest effect on like gold because people have been buying Bitcoin instead of gold. And it will have some effect on the FX market because instead of buying some other currency besides the dollar, you might buy a digital currency. But overall, in the market, it would be very indirect and small, in my opinion.
Curious, you talked to a brief comment earlier on AI affecting our state. The way we look at the market. And I've never been real fond of computers making trades opposed to people. And I'm concerned about the future of AI making the market even more volatile. As as it gets more involved and
Yeah, so directly in the market, so I'll just comment, so I'm a quantitative equity investor, so that means we build a lot of models to pick stocks. Now, there's all kinds of different quantitative traders. We use a very small, oh, yeah, sorry, my bad. So the question is AI and how will that affect the markets? How, like, if we have an AI bot doing the trading for it?
and more directly, how it can affect trading as opposed to value. I mean, you can go after the sector that I'm not talking about the sector, I'm talking about its effect on trading.
Yeah, so what's the AI effect on, like, so like Wall Street starts putting these in your algorithm, how it's gonna affect trading? So what I'll say is I do think this ChatGPT, like AI has been around for quite a while and models, and even like a regression is like a machine learning model. And so when you look at it, like, I think this AI revolution has gotten, cause you can touch and feel ChatGPT, like I think everybody's kind of getting the, like, some touches to this, but at the end of the day, Wall Street for the last good bit of my career has been really algorithmic based already. And there's all kinds of different ways that we trade, and at the end of the day, we're trying to minimize market impact, like, you know, our firm is buying different stocks, and we wanna get the best trade that we can get. So do quant models move the market sometimes? Absolutely. But that's been the case for a number of years right now. So it's not necessarily that what's changed in the last, you know, couple of months has had a major impact. Now, are we looking at using some AI in some of our stuff? Yes, but for the most part, we would not, we're not gonna change our systems that we've used for the last 10 years just because there's a new shiny ball out there. So but it is a well point that, you know, sometimes you will see moves in the stock market on different days, and it is driven by algorithms or something happens. So the best example of this was 2 Mondays ago, out of nowhere, NASDAQ announced a rebalancing of the NASDAQ 100 index. Well, that caused a lot of movement underneath the surface that had nothing to do with fundamentals. Here, but this is what I would say is long term, if you buy into the stock market, if you're a buy and hold investor, you don't have to worry about the short term trading, because at the end of the day, stocks are going to move on earnings over the long run. Go ahead.
Does the fact that next year is an election year affect at all what the Fed does or does not do or how they do?
So the question is, because next year is an election year, does that affect what the Fed does? So the Fed's independent, right? I don't have all the two, obviously different presidents appoint different people. I would say, look, overall with the stock market, I think we spend too much time looking at politics. If you actually look at when the market actually does the best, it's actually when there's not one party in control of everything. So when nobody's available to screw everything up, it is generally when stock market does the best. And yeah, Fed is supposed to be independent. I don't think at the end of the day, I think what the Fed is looking at right now is where is inflation and where's the jobs, and that's really their two key, the dual mandate. And I don't think that there's going to be a major effect based on the elections. Now, would the current Joe Biden President Biden would probably love them to cut rates next year if we start to see a slowing economy. But I think they would only do that if they actually saw inflation lower. I think we're good.
Tom, before you come up, I just wanted to say that, I hadn't heard what he was gonna say, but I wanna reiterate what, I said earlier, and that what we're gonna be doing is we're going to be reducing our exposure to those expensive technology stocks that we spoke about. And we're gonna buy, the stocks that aren't as expensive, the dividend paying stocks. And, but we've had a good run up in that technology. I think our technology funds up like 55 or 60% year to date. So we're gonna take some profits from that. But our overall equity exposure will be the same. It might be 1 or 2% more, but it'll be hovering around 50% with about 40% in bonds and 10% in cash. And you know what, I just wanted to also say that, so we have cash on, on the sidelines. We raised cash, over a year ago, with more in like January, February of last year. And the purpose of that cash was to be able to put it back to work, at more attractive prices than where we got out. And so you're messing it up and you're taking it out. That was a joke. So, Anyway, I just wanted to remind you that that's the direction we'll be going, and you'll see a trade come through probably sometime by the end of the week, of the next week, so. Tom, you wanna close this out?
All right, thanks again, guys. Thanks, everybody, for attending this evening. We really appreciate you guys as clients, as friends, and it's nice to see you. Couple things. Number one is if your menu has a sticker on the back of it, you get to take home the floral arrangement. All right, who's the winners? All right. All right, and also, we'd like to give a big thanks to all our loyal clients and super smart people and people that have referred clients to us. You guys know who you are, so there's some gifts at the table on your way out, so help yourself. Only one per person. Kidding. So that's it. Thank you very much, guys. Really appreciate seeing you. Yeah, and I lied. Hold on one more second. Hold on, Mr. Wicks. I have a little speaker gift here, so Chris, come on up. I'm the one that messed up the rap job, so I apologize. I know Ann took time to do this, so I'm sorry.
Thank you so much.
You bet. You wanna do a one-on-one there? Yeah, no problem.
This is a good idea.
In these volatile times, it,
Not a good idea.
well, if you'd like, you can actually get your statements on a monthly basis. We could switch that for you, so that's fine. I think the bottom line is if you want that, just go ahead and let us know and we can make sure that it's a click of a button and it's done, so.
Yeah, I have a question about the statements, the new statements, will they show us the cost?
Like the cost basis on there? That's the one thing I cannot, I'll get that answer to you before the close of business tomorrow, but I do like, the thing I do like is the fact that it's going to have the performance year to date and quarterly, so it's not just gonna have a starting value and an ending value, and you gotta figure it out yourself, so we're making some progress.
So just to actually quote Nancy Davis right there. To quote Nancy Davis right there, she once said to me, looking at your account often doesn't make you any richer, it just makes you more nervous.
Thank you, Nancy. All right, good night, everybody. Yes.
All right. Thanks, Mike.